Well, good morning, everybody, and welcome to our first webinar from the 128 Innovation Capital Group. And I'm so delighted to have Norman Meisner with us this morning. Norm has been a good friend of the 128 Innovation Capital Group since I've been running it for the past 10 years. I know that this is kind of an experiment for us, and I feel rather prophetic given the weather that we've had that we've decided to meet in cyberspace rather than face-to-face. I don't think I could have faced getting up early this morning and traveling over any place. I did see yesterday where somebody said driving and living in this area right now is kind of living in a corn maze, except instead of corn, we have piles of snow. And sometimes I feel like that tests the rat running through the maze to get around. But I do want to welcome you all. All of the attendees are in listen-only mode. I will be looking for questions that you have, and Norm will as well, and we'll try to get to them if necessary during the presentation. Now, here at the 128 Group, we see a lot of entrepreneurs in startup mode, young companies. I was going to say young people, but young companies. And a lot of them are so thrilled with what they've been able to create or what they've conceived of that they make an assumption that everybody else is going to be just as thrilled. In my 10 years of hosting meetings for the 128 Innovation Capital Group, I found it's never quite as easy as that. So I thought I would pick Norman's brain today. And I was going to half tongue-in-cheek call this program What Women Want and cross out women and say what investors want, because that always seems to be the question. How does a young entrepreneur with a great idea gather the attention of people with money and actually convince them to spend money with this company? Now, we know that for early stage companies, there are two major outside investment types of companies. There are venture capitalists, and some do invest in early stage companies. And in my mind, Norm, correct me if I'm wrong, those are maybe no more than $2 million and probably closer to the $1 million mark for a startup for the first round.
Yep.
And then we have angel investors, and we can further break down angel investors into individual investors and those that are working with the group, some of which begin to sound like a venture capital firm. Norm, you've had experiences with both. You're an angel investor, but you're also one of the principals in a micro VC firm. Is that correct?
That's right.
Can you tell us what the major differences are?
Sure, my pleasure. And by the way, thanks for inviting me to this.
I didn't give you a bio, did I? You're a physicist who made some money and now invested, right?
That's the exact bio, perfect. So you asked about the differences between venture capital and angel investors, and there's a whole bunch of them. I won't go into it too much depth. That's not the subject today, but the venture capital community raises money from outside investors that are passive, and you typically create a fund that's about 10 years in duration, and they look for investing over the first 3 years and then collecting the rewards over the next few years before closing down that fund. The economics of that kind of force them into looking at a little bit later stage companies. They need companies that will exit in the 5 to 7 year time frame. And given that the average exits have been more like in the 8 to 10 year time frame, that means they tend to look for a little bit more mature opportunities. They also have to put a significant amount of money to work in any given opportunity. If they raise a $100 million fund and there's 2 partners that are going to sit on boards, there's a limited number of companies they can invest in. And that means that they have to be able to see that they can put to work typically $2 to $5 million. And for the larger VCs even much more in order to move the dial. That makes it impossible for them to get into early stage and seed round companies. And some of them have been creative and created small micro funds within their funds to invest a little bit in seed companies, but that's pretty rare still. The angel community basically fills that gap. And it fills the gap between the first money you get, which is typically friends and family financing, the individual investors you might have found along the way as you've networked, and the angel community syndicates deals between the various angel groups and can typically invest anywhere from $1 million to $3 million in a round. So filling that gap, doing things a little bit earlier stage than the venture capitalists.
Okay, I did a fast check yesterday on Economy. We have about 30 angel groups in Greater New England. And I'd like to focus on angel groups rather than individual angel investors because we can find them. Okay, I have people constantly ask me, how do I find a single angel investor? It's kind of the same way that you find an angel group or you get into an angel group, but it's difficult to identify them ahead of time. So what groups are you a part of, Norm?
I'm part of Launchpad Venture Group, which is the largest angel group in New England. It's got 150 members.
Okay, and about how many deals how many pitches do you listen to, let's say, in a year?
It's very interesting that you asked that since we had our meeting yesterday and those statistics for last year were presented. And so about 750 companies applied to Launchpad. We listened to 29 pitches. So we did a lot of screening beforehand before companies were even allowed to come in to pitch to us. We funded 8 companies out of that. There's a couple more that are still in due diligence, so it could add to that total. And so Launchpad typically listens to about 30 pitches in a year, and over the past couple of years has funded in the vicinity of 8 to 12 startups. We also participated in 25 follow-on rounds during 2014. So the angel groups do typically stick with the entrepreneur as the company is growing.
That's good to know. So if I were to go back to the original statistics, you said you had about 725, 50 people apply to present, and you've made 8 to 10 investments. So we're looking at 1.5% close rate, if you will.
That's correct. And the full number of 750 includes some that just came in over the transom, which is the worst way to approach an angel group.
Yeah, we're going to discuss that. I liked your ideas, actually.
Yep.
So we'll get there. Now, let's backtrack to the original question. What do investors want? What's going to grab your fancy first off when somebody approaches you?
Well, first you're getting kind of the elevator pitch initial impression of the person. It's got to be a reasonably polished pitch. It's got to hit on the high points that you know an investor's going to want to hear in order to entice them to listen further. And probably the most important thing in that first discussion is for the entrepreneur to identify a unique pain that they are addressing in a unique way. It's great to have a good idea, but if the market doesn't need it, it doesn't get anywhere. It's great to have a good market opportunity, but if you've got the idea falls short and doesn't meet the need, it's not going to get anywhere. So you really need to have to be addressing a pain for consumers, for other businesses, depending on where your company is focused. You need to be able to describe who needs this product or service, why do they need it, and when do they need it. And when is an important part of this, because if you're dealing with something that is a need far in the future, then you're going to need a whole bunch of money in order to sustain the company until it becomes a real pain that people buy products for.
What I find very interesting and really pretty predictable is that entrepreneurs come up with ideas that affect them in their current lives. For example, I've been involved in the past with several of the universities and their entrepreneurial programs in Boston. And as the entrepreneurs pick a company or an idea, I think most of them have to do with the entertainment scene in Boston and the best way to get people to restaurants, movies, venues, and what have you, because those are the parameters that circumscribe a student in Boston's life. Okay. I'm not sure that all entrepreneurs take a look to see what is outside their immediate environment. And could you talk to me about the importance of market analysis and understanding the market?
Of course. You're absolutely right. People tend to do what they're comfortable with, what they know something about, and that could be a fairly limited view of the world. What we tend to look for as investors is a decent market that they're going to be addressing in size and reachability, and not one that's just derived from a top-down analysis. A very experienced investor once taught me something. He said, beware of the company that pitches you the equivalent of the Chinese glove market analysis. And that analysis is that there's 1.3 billion people in China, and that means there's 1.3 left hands in China. And if I sell left-hand gloves only and get only 1% of the market, I'll have an enormous business. And you have to watch out for top-down analysis being deceiving about what can be achieved. And really what we tend to look for is a bottom-up analysis. Namely, look at what your product can do, look at who has the pain, and then use that to derive what you think the total market is by what you think you could get as a price, multiplied by the number of people, companies, whoever you're selling to, and develop a market size picture like that with an eye toward what is your addressable part of that market. What part of the market can you reach? You might be selling things against a significant embedded competitor. There's going to be companies you're never going to be able to sell to in that case. You're going to be able to sell to the early adopters and the people that are willing to break away. So your addressable market is smaller than the total market. Still might be a good market, but you need to be able to build that up. And before you really talk to investors from the standpoint of getting money, not from the standpoint of mentoring, we'll talk about that separately, but from the standpoint of getting money, you really need some verification that that market exists as you've described it. Now, that could be some early revenue. It could be some ongoing trials that are going on, some partnerships that you have in development, people and companies that the investors can talk to verify your view of the world. Because the investors are not experts in whatever you are an expert in. And you need to have some reasonable guess as to what the competition is in the market that you're going after. So you can see how you differentiate, how you segment, how you can develop what it is that you're trying to achieve.
Okay, Norm, I've got somebody, I think, trying to get me on the phone. So I'm going to ask you a question now. You mentioned revenue at this point. Talk to me a bit about a young company, pre-revenue. how do they prove the market if they don't have money to do that? Or should they even be in business if they don't have money to do that?
No, I'm not discouraging them from being in business. Hope we're getting feedback. I think with Nick going off, created a problem.
Into my
Hello? Okay, it sounds like things are better now. So it doesn't have to be revenue, but it has to be some proof point that revenue can exist. So that's why I mentioned it could be early trials. Great if you can get somebody to pay for that trial, but not mandatory. But it, the fact that they're dedicating some resources to looking at whatever your product is shows a pain and a seriousness of intent. So that can take the place of revenue. If you're really early and pre-revenue, then you're probably better off trying to get friends and family money to get off the ground. The angel groups typically look for a bit more credibility in the market, as I've just described, rather than taking it as an engineering project and allowing you to then develop the market going forward. So that's the stage of friends and family money. Typically, we see companies coming to us that have already raised $500,000 or so and are along the way of spending that before they even come to an angel group.
That's really great advice, Norm. Now, when a company approaches you, either as an angel or a VC, what type of structure are you looking for? Are you looking for a couple of founders who are working in the laboratory and have, some investors? Or are you looking for a company a little farther along, perhaps with a board of advisors or board of directors? How does that all fit together?
Yeah, it does vary a lot, Annette. Clearly the most important part of evaluating an investment is evaluating the people involved. The only thing we know for sure is whatever spreadsheet an entrepreneur shows us for revenues and for expenses and time to get to cash flow break even. The only thing we know about that is that it's wrong. We just don't know where it's wrong or how it's wrong, and neither does the entrepreneur until things are tested. And so we need to get a good feeling about the people involved, to know how flexible they are, to know how coachable they are. Are they interested in listening to mentoring? Do they think they know everything? Sometimes that works. There's the occasional Steve Jobs in the world who doesn't need to be mentored, or didn't need to be mentored. But even so, there are usually good pieces of advice you can get from people who have been out there. And, so we look for people who can encompass that within their ideas and, basically take them in and make them their own concepts and ideas as well. So, prior successes are useful. It's not a mandatory thing, but it's useful to have some prior successes. It's useful to have some domain knowledge. If you've been an electrical engineer all your life and you tell me you're going to build the next drug to cure cancer, I'm probably going to be a little skeptical. So domain knowledge really helps to give us the warm feeling that you know what you're talking about. In terms of the breadth of the team, we have invested in single founders that have some director or worker D level people working with them. We've invested in teams of people that are co-founders. We tend to prefer the co-founder environment a little bit because it allows the entrepreneurs to have the sounding boards internally, to be able to analyze what's going on and not be caught up in their own ideas so much that they don't do reality checks periodically. So, we look for that breadth. We look for people that can work together well. I mentioned the flexibility. The majority of my investments that have done reasonably well are not exactly the companies they set out to be. They have pivoted along the way. They've adapted to the market changes that they've seen. And so we need to be able to see that that flexibility exists. And part of what we're going to be looking at is, do you know what roles have to be filled? If you come in as two engineers to get a product to market, and you don't realize that you need somebody who will fill a marketing and sales role, and at what stage to bring those people on, then we get suspicious about whether you're capable of running the company.
Okay, one of the things that I know some entrepreneurs worry about is once outside money comes in, they lose control of their company and the decisions. And I'm assuming that's because they now have a formal board and they're not in complete control of the company. Can you speak to that at all?
Sure. It's a common concern, and I would point people who are interested to read the book called The Founder's Dilemmas. Can't remember top of my head who the author is. It'll come to me, I'm sure. But he's, I believe, at the Sloan School. And it's a great study that was done of over 1,000 startups. And he looked at the single founder startup and the multi-founder startup. And he also looked at the startups that took in money and the startups that bootstrapped. And he found that the situations in which a founder brought in lots of expertise from the outside, in the form of both money and advice, that entrepreneur, on average, made out better at the end of the day when the exit came than the founder who kept things close to his or her vest and decided to maintain as much control over the company as possible. So, he had no prior biases. This was an objective look at over 1,000 companies and their results. So I think that points to the fact that if you bring in the right investors, the right angel groups, to help you get the company going, that's what we're there for. We're there to help you get the company going. We don't succeed unless you succeed. And we try to be very cautious about things like term sheets to make sure that there's enough equity on the part of the founders and other employees who are key to the company, so that in follow-on rounds that are invariably going to happen, they would be able to maintain enough equity going forward to be able to be sufficiently motivated to make a lot of money at their startups. So it's important to us. We're not the enemy in this. We're trying to be an ally to give you the highest probability of success.
Very sound advice. Now, let's jump ahead. Let's say you've made the investment, you've been mentoring this company. Talk to me about lifestyle versus venture companies and exit strategies.
Sure. So, lifestyle versus exiting companies. If we get an inkling that this particular project could become a lifestyle company, that's our quickest exit that we will make. And the exit is from the meeting. We are not interested in investing in lifestyle companies. When you started the question, what do investors want? Investors want profits. And you don't get any profits from lifestyle companies. You get satisfaction in helping somebody build a company, but that's about it. So we are looking for exitable companies. And these days, that invariably means companies that can be acquired, since there are so few companies that reach the IPO stage anymore. So we are clearly looking for what kind of company this is, what kind of market there is for the product or service that's being offered. And if, I know personally, if I can't think of 5 significant companies that would be interested in acquiring this opportunity, should it be successful, then I don't take it past the first meeting, because I have to be able to see that. Time frame is another aspect of it, but I have to be able to see that this, if it succeeds, would be attractive as an acquisition candidate.
I have heard recently of some companies offering dividends in lieu of selling out. Is there any traction in that concept at all?
Not very much. I've invested in one that does that, which was a launchpad investment. It's a tricky game. The big problem is one of taxation. So if you have a company like that and it's going to be profitable, the company's going to pay taxes on their profits. Then if you distribute what's left over to the investors, the investor's going to pay taxes on the dividends at the highest possible tax rate. So you get double taxed on the money that comes in. And that usually is not a winning proposition. There was an interesting case in a successful exit that I was involved with, where the company was looking at a licensing agreement for its product, which was in the pharma space. And at the last minute, the company went back to the 2 potential licensors and said, we're not going to do this. We want one of you to buy us. And the reason given was this crazy taxation situation that would have occurred. In fact, it was an attractive enough company that Merck, in this case, said, okay, the price is going to be a little bit lower than the licensing deal because it's less attractive to us from a tax standpoint, but they made the acquisition. So that's how vehement we are about probably staying away from dividend-paying situations.
Okay, let us just say that I'm an entrepreneur. I piqued your interest. You've called me back for a second meeting. You're starting due diligence. How do I know how much money to ask for? Or how do you determine how much money you're going to invest? Okay,
fair question. So clearly you're going to have put together a pro forma spreadsheet of what you think you need. And as I said, just a few minutes ago, it's wrong. And you'll end up needing more money than you think you'll need. But we factor that in as part of our considerations. We are going to look to you to tell us first how much you think you need. And that's going to be based on your assessment of how quickly you can grow in the market and what kind of expenses you're going to have to get there. Cost of customer acquisition, cost of customer satisfaction, cost of product. Then we're going to sit with you and say, okay, we're interested. Let's go through these numbers in great detail. And, we'll get some people. If it's Launchpad, we'll, draw on the talent of the 150 people that are in there to pull a couple of people into a meeting who either have been in your industry before or are, CFO types, to sit down and go through the numbers with you. And we may recommend, no, you're raising too much now, you're raising not enough now. This is all part of the overall strategy, which brings me to an important point. It's really important to look beyond this first fundraising that you're doing. and have a clue about what you're going to need for a follow-on financing after this. Because we're going to look at that to try to analyze the dilution that we're going to suffer and the dilution that you're going to suffer as an entrepreneur, to make sure that things work out in the end for everybody. And so the total amount you need is important. The amount you need now is important. We may counsel you, and I've done this very recently. There was a company that was looking for $3 million. And I said, do you really need the $3 million now? Why don't you take $1 million to $1.5 million now? At a valuation that you'll be able to get investors at, prove some milestones, revenue milestones, market penetration milestones, and raise the other $1.5 million later at a much higher valuation. It's good for the entrepreneur in terms of the amount of equity they give up in their company, and it's good for the investors in that they put up a little bit less money now when things are extremely risky, and they come in for another tranche later, and have to pay a higher price per share, but the company has eliminated some of the risks, so that's fair. So we'll work with you, but you need to have the first inkling of how much money it is that you're going to want to raise.
Okay. Another question that has always seemed like magic to me is, how do you determine the value of a company? Now, I realize books have been written on this. We don't have that much time, but and that all ties into the amount of equity you get, or whether or not you use a convertible note. And am I pushing you too hard to ask you just to make a few comments about that?
No, not at all. It's pure art. There's no real science to it, although some people have tried to apply science. I saw a paper once that had 10 different valuation methodologies in it. I tend to use a pretty simple one. Given that half of the companies or even more that I invest in are going to fail, and another 2 or 3 are going to have a moderate exit, and maybe 2 are going to have really good exits. In order to get a reasonable return on investment in the total portfolio, I need to be able to see that I have the opportunity to make 10 times my money on a successful exit. So I look at a company and I say, okay, this company is looking for $3 million, and they'd like it to be on $5 million pre-money valuation. That means the post-money valuation has to be $8 million. And there'll probably be a follow-on financing round after that. So I'll get diluted down some amount. So in order for me to get my 10x, this company has to sell for $120 million. Can it reasonably do that? If that doesn't make sense to me, I walk away from the situation. So I kind of work backwards from an exit value to help me figure out what the valuation of the company is on the going in. Another aspect of the valuation going in is there are magic numbers out there, and for companies that are early stage, 3 million is kind of a magic number for valuation. If you're going to raise $1 million, you're going to give away about 30% of your company to the investors that come in. If you're going to raise, and that's part of the reason I counseled that company who was looking for 3 million to raise less now, because if they wanted to raise 3 million up front, they'd have to give away half of their company in order to do that. That was just unfair at the stage that they were at. So you can pretty well figure that to get an angel group involved in New England for a first Series A investment, you're probably looking at a valuation down as low as, say, 2.5 to up to maybe $3.5 million pre-money valuation.
Interesting. Thank you so much. Now, the question that I'm always asked is, can you introduce me to somebody with money? And I have to say that one of my personal rules is I do not make introductions of companies to investors because I don't want to squander any referral capital I have, and I'm not always sure about what you're looking for. So the challenge for a young entrepreneur is to gain your attention. You gave me one suggestion yesterday. I'm not sure it's going to work. What Norm suggested is that you stand on a rooftop naked with a megaphone. But I don't know how realistic that is in this weather, Norm. How do we catch your attention?
That's absolutely true. Definitely do not go out there that way today. I won't pretend it's easy. It's not. But it's all about networking. And it means going to every venue that you can think of, including your group in it, where, investors show up periodically, their speakers, etc. Buttonhole them after the session and say, will you listen to my elevator pitch? And typically we will. So, it's not a waste of our time. You don't have to be shy about it. We're happy to hear that. There's also, other opportunities out there. There's the Capital Network, a very good way to meet investors and learn things about term sheets and, other financial things that you're going to have to learn as part of building a company. And, if you can apply to folks like Mass Challenge and try to get into their program, those accelerators are wonderful because they provide investors first as mentors and then potentially as investors going forward after that. But it truly is about networking. Going to an angel group and throwing in something over the transom, if you go to the Launchpad Venture Group website, there's a place to submit your application for funding. And it says referred by. If that line is blank, it won't even be considered. Don't bother. So you've got to find somebody first who will bring you into an angel group and lead you through the process and be your champion through the process of trying to get the funding. And that happens by networking around. So, absolutely be somewhat aggressive about approaching people and use the tools that are in this great infrastructure that we have. If you're, coming out of MIT, there's the MIT has a venture forum. There's ways to meet investors that this area has uniquely, and you should use every possible way.
I will say that after our meetings, I am so very impressed with the fact that the speaker, who is always an investor, will just stand there and listen to what people have to say and follow up with them. The other thing that impresses me tremendously is the large amount of mentoring that the angels I know do, even for companies they don't invest in. It's really quite a unique environment that we have here. Norm, I'd like you to take us for a trip now through one of the investments that you've made that you thought might be interesting to the group. Give us your thought processes, how you met them, and what happened after that.
Sure, happy to. And the one that comes to mind is a recent, very successful exit, Boston Heart Diagnostics. So I actually met them when I was a member of a different angel group, not Launchpad, but Beacon Angels at the time. I was not the original investor that they found to sponsor them into the group, but I listened to their pitch, and they were building a diagnostic test for cholesterol screening. We all know, because we go for our annual physicals, that, get your LDL down, get your HDL up, and life is good. And that's probably true if you're healthy. If you've got heart disease, there are about 8 or so different subcomponents of HDL, some of which can be healthy if they're high, some of which are unhealthy if they're high, especially if you have heart problems. And there was an eminent researcher in the field, Dr. Schaefer, who came up with this and came up with the tests to be able to separate out these various subcomponents. So we had the technology from somebody who really knew the domain. The technology was patentable, so we had the IP protection. So, okay, unique advantage. There were other labs out there that were providing diagnostic tests to people who had heart problems, but these were going to be unique. They brought in 2 key players. One was a former VC from the who had funded companies in the pharma industry that came on board as an initial investor and as a member of the board of directors. And his influence allowed them to set up the funding properly, namely a proper Series A with good paperwork that was not egregious to either the investors or the entrepreneurs, so that follow-on money that came on did not force changes to the initial investments. And they brought on a CEO who had experience with taking very early stage companies like this, getting them up to a certain level and flipping them, selling them in a merger and acquisition transaction. So they had the ingredients, although no proof points yet in terms of revenue or marketability. We put some money into Series A, and they started to build the company. They hired their first salesperson out in the field, and here's an interesting question. You're building a company to provide a specialized heart diagnostic test for people with heart problems. What part of the country do you put your first salesperson in? And the answer that came to the CEO was pretty obvious. You put the person in Atlanta to cover the Southeast. You wanted to cover the part of the country where people eat shrimp and brown gravy over buttered grits for breakfast.
Oh, sounds good.
Right. And where the greatest percentage of heart problems are. And they put their second salesperson in there and the third person in there. So they concentrated on the Southeast because they analyzed and understood their market. And they started to grow sales. And the sales grew very consistently. We had several rounds of financing, and I was happy to participate in each round. I brought it to Launchpad Venture Group. Launchpad signed on, as did several other angel groups, so it was a syndicated deal. About 2.5 years into it, they needed expansion capital to really build out their laboratories because they were growing nicely. And they got a venture capitalist in, Bain Ventures. And because of the early work by that board member that I mentioned, the Series A and the Series B were so well written and so appropriate as financing vehicles that when Bain came in, they did not do as venture capitalists sometimes do, and that is cram down the early investors as part of putting their money in. They looked and they said, okay, everything's been done here fairly. They actually based their paperwork on the earlier paperwork. So the Series C looked very similar, and they did it in a way where they were pari passu with the early investors. What that means is if the company did not do well and sold out for less than the total investment, Series A, B, and C would share equally in whatever was left over, as opposed to Series C, the new money, taking it all. So, having done a professional job of setting up the company in the beginning allowed everybody, the early entrepreneur and the early investors, to benefit from that going forward. The end of this tale was the company was acquired for $140 million up front and another $60 million as earnouts over the next 3 years. And the first checks arrived on January 30th of this year. So, you know, it was a great success story, and it was, you know, if I had to look at what are the key takeaways from that, it was a disruptive technology in an area where there was significant pain, and it also benefited from the confluence of that with the growth of personalized medicine as a way to do business. So we took that into account when we did the investment, saying, okay, if personalized medicine continues to grow, then more people are going to want these much more personalized tests. So, you know, again, what was the pain? What was the real addressable market? And what kind of team did they put together? And then we let them fly from there.
It also sounds as if everybody benefited from good legal and financial advice in setting up the investments as well.
Absolutely true. You know, the more usual cases, a VC comes in the later round and says, oh, this is garbage. You've got too many early investors. You're going to have to buy some of them out. You're going to have to get rid of them. We're going to have to push them down in valuation. And by the way, we're going to hurt you at the same time because we have to do it equally to everybody. And it just is an ugly outcome. This was so well prepared and well thought out that it created a win for everybody.
Sounds good. Now, to the audience, you do have a chat feature here. If you have questions for Norman, just type them on in and we'll try to answer them as we can. I think you did a good job, Norman. Let's wait a couple of seconds, see if anybody wants to ask you any questions.
Sure.
Now, I have one more question for you. What did I forget to ask you?
I don't know. Oh, you know what? One thing I didn't talk about, I think you asked about it before, but I didn't really address it, was board of advisors.
Yes.
Really important to get people who are truly experts in what you need as mentors in the company and as outside advisors. We look for that. There was a recent investment we made, 2 gentlemen out of Sloan. One was a microfluidics expert, and they decided to build a new EpiPen to compete with, you know, the EpiPens that's out there right now for anaphylactic shock. You know, sounded like a good idea, but one of the things that sealed the deal for us was that they found an advisor who was the retired CEO of the company that invented the EpiPen and sold that to Mylan Labs. Well, sure helps to have somebody like that advising you and giving confidence to the investors to allow them to proceed forward. So, you know, we do look for who you're surrounding yourself with. Don't be afraid of surrounding yourself with people who may even be smarter than you. That's okay.
Okay, well, I have seen no messages come from our audience. Norm, I want to take this opportunity to thank you so very much. I did record the session, and I will make this available probably up on YouTube. And I just don't know how to thank you so much. Words of wisdom.
Well, I appreciate the opportunity. You run a great group, and I've enjoyed the meetings that I've been to. I encourage everybody who's out there who's an entrepreneur, reach out. I'm happy to listen to ideas, so are other investors.
Thank you all so very much. We will see you next month. We will have in March, on March the 12th, a face-to-face meeting over at Constant Contact where we're going to be talking pitches In fact, it's going to be a pitch party as well. Also, the end of March, another Piranha Pond out at Clark University in Worcester. You will receive announcements on that as well. And in the meantime, any questions at all, just email me, text me, call me, and we'll try to resolve whatever issues arise. Norm, again, thank you. We'll see you all next month.
Okay, take care, everybody.